You've probably heard that debt is a bad thing, something to be avoided at all costs. But what if I told you that millionaires see debt in a completely different way? While most people fear debt, millionaires use it as a powerful tool to build even more wealth. They follow a rule that many are unaware of, the rule of investment with debt. In this video, I'll show you exactly how millionaires use debt to make money, leverage their investments, and grow their fortunes. And the most interesting part, this strategy isn't reserved just for the super rich. With the right knowledge, you too can apply this rule and transform your finances. Stay with me until the end to discover how this strategy works in practice and how you can start using it today. Let's get started. Rule 1. The difference between good debt and bad debt. To understand how millionaires use debt to their advantage, we first need to differentiate between two types of debt: good debt and bad debt. Bad debt is the kind you incur to buy things that don't generate financial returns, like using a credit card to buy clothes, gadgets, or take vacations. These debts usually have high interest rates and only drain your money, offering no long-term benefits. Good debt, on the other hand, is the kind you use to acquire assets that generate income or increase in value over time. For example, a loan to buy a property you can rent out or invest in a business that will generate profit. Millionaires understand that debt, when used correctly, can be a powerful tool to increase wealth. They don't avoid debt, they use it strategically. The secret lies in using other people's money, the famous OPM, other people's money, to make more money. Instead of using all their capital for a single investment, they use debt to leverage their resources and multiply their gains. This concept of leverage is fundamental to the millionaire's investment strategy, and it's something anyone can learn to apply. Rule 2. The leverage rule. How to multiply your profits. Leverage is one of the main reasons why millionaires use debt to invest. Simply put, leverage means using borrowed capital to increase the potential return on an investment. Imagine you have $100,000 to invest in real estate. With that amount, you could buy a property outright. But if you use that amount as a down payment and take out a loan to finance the rest, you can buy several properties instead of just one. Suppose you get a $400,000 loan to buy 4 properties worth $125,000 each, putting $25,000 down on each one. Now, you have 4 properties generating rental income instead of just one. If each property generates $1,000 per month in rent, your monthly cash flow is $4,000 instead of $1,000. Even after paying the loan interest, you're still making a bigger profit than if you had bought just one property without leverage. Millionaires apply this rule in various areas, not just real estate. They use leverage to invest in businesses, stocks, and even to expand their own companies. By multiplying the capital they have available, they can exponentially increase their returns, accelerating the wealth-building process. Rule 3. Using debt to buy productive assets. One of the main ways millionaires follow the rule of investment with debt is by using that debt to buy productive assets. Productive assets are those that generate cash flow or appreciate over time. This can include rental properties, profitable businesses, shares in solid companies, and even patents or copyrights that generate royalties. Take the example of a rental property. A millionaire might take out a loan to buy an apartment building. The rent from the tenants pays the mortgage, taxes, and maintenance, and still leaves a profit. This profit is what makes the debt good. Over time, as the property appreciates and the debt is paid off, the investor's equity increases, creating even more wealth. Another example is using debt to acquire a business. Millionaires often buy companies using financing. They improve the efficiency of the company, increase profits, and then sell the company for more than the purchase price. In this process, they use the company's revenue to pay off the loan and still make a substantial profit. The key is ensuring that the asset purchased with debt is productive enough to cover the debt costs and still generate profit. This requires careful analysis and effective management, but when done correctly, it can be one of the most effective ways to build wealth. Rule 4. The importance of risk control. While leverage can multiply profits, it also increases risks. That's why millionaires are extremely careful when using debt. They know that the same leverage that can amplify their gains can also amplify losses if the investment doesn't work out. That's why they apply strict risk control strategies to ensure their debts don't become a burden. One strategy they use is ensuring that the cash flow generated by the asset purchased with the debt is more than enough to cover the debt payments, even in pessimistic scenarios. For example, if a property's vacancy rate increases or the economy goes into a recession, the millionaire still needs to ensure they can meet their financial obligations without compromising their overall situation. Another aspect of risk control is diversification. Millionaires don't put all their eggs in one basket. They diversify their investments across different asset classes, sectors, and geographies. This reduces the impact of any investment that doesn't perform as expected. If one asset doesn't generate the expected return, other assets in the portfolio make up for the loss. Additionally, millionaires often negotiate favorable terms for their debts, such as fixed interest rates, longer amortization periods, and flexible clauses that allow for debt restructuring if necessary. This gives them an additional margin of safety and reduces the likelihood that a debt crisis could compromise their financial position. And if you like the idea of earning between $5,000 and $10,000 per month as extra income by creating simple videos for YouTube like this one, I have a complete and straightforward course that I developed for a single payment of $29.90. $29.90 won't make you richer or poorer, but what if this program works for you? Well, the link is in the first pinned comment of the video and in the About section of the channel, okay? If you're interested, just click the link to know more. But now, back to the content. Rule 5. Reinvesting profits to grow wealth. Another way millionaires use the rule of investment with debt is by reinvesting the profits they make from their investments. Instead of spending all the money they earn, they reinvest in new assets or use the money to pay off debts more quickly, further increasing their leverage capacity. For example, a millionaire who invests in real estate might use the rental income to buy more properties or pay off the mortgage on one of the existing properties early. By doing this, they increase their equity and the amount of capital available for new investment opportunities. This creates a virtuous cycle of growth where money earned from debt generates more money, which in turn is used to generate even more wealth. This reinvestment cycle is key to long-term wealth building. While many people fall into the trap of spending all the money they earn, millionaires understand that the real power of wealth lies in the ability to generate more wealth from the resources they already have. Reinvesting profits also allows them to protect themselves against unforeseen events, ensuring they have a solid financial foundation even if they face temporary difficulties. Rule 6. Using low interest rates to the investor's advantage. In a low interest rate environment, like the one we've seen in recent years, millionaires see a golden opportunity to leverage their finances. Low interest rates mean that the cost of borrowing money is reduced, making it cheaper to finance investments that can generate high returns. This is one of the reasons why many millionaires take advantage of economic crises or recessions to expand their asset portfolios. For example, if a millionaire can get a loan at a 3% interest rate and invest that money in an asset that generates an 8% return, they're making a 5% profit without using their own capital. This difference may seem small, but when applied to large sums of money, and over time, it can result in a significant increase in wealth. Moreover, millionaires understand that in an inflationary environment, where the value of money tends to decrease over time, debt can become even more advantageous. If the money they borrow today is worth more than the money they'll have to pay back in the future, they're effectively paying less in real terms. This is one of the reasons why many millionaires are willing to take on debt, as long as they can invest that capital in assets that outperform inflation. Rule 7. Using leverage for diversification. Millionaires also use leverage to diversify their investment portfolios. Instead of putting all their capital into a single investment, they use debt to expand their exposure to different assets and markets. This not only increases the potential for return, but also helps protect against risks. For example, A millionaire might use leverage to invest simultaneously in real estate, stocks, bonds, and businesses. If one market experiences a downturn, other investments can offset the losses. This creates a safety net that helps ensure their wealth continues to grow, even in times of volatility. Diversification through leverage allows millionaires to explore opportunities in markets that might otherwise be out of reach. They can invest in emerging markets, tech startups, or new real estate ventures, taking advantage of growth in different sectors and geographies. This maximizes the potential for return and minimizes overall risk, creating a robust and resilient portfolio. Rule 8. How millionaires turn debt into financial freedom. Ultimately, the reason why millionaires follow the rule of investment with debt is that they understand how to turn debt into financial freedom. They don't see debt as a burden, but as a tool that, when used correctly, can accelerate the path to financial independence. By using debt to buy productive assets, leverage investments, and diversify their portfolios, millionaires build multiple streams of income that continue to grow over time. These income streams allow them to live comfortably, invest in new opportunities, and still have the financial security to face any challenges that come their way. Financial freedom is the ultimate goal, and debt, when used strategically, is one of the most powerful tools to achieve it. Instead of working to pay off debt, millionaires make debt work for them, generating income and increasing their wealth over time. Millionaires follow the rule of investment with debt because they understand how to turn liabilities into assets and use other people's money to build their wealth. They differentiate between good and bad debt, use leverage to multiply their profits, carefully control risks, and reinvest their gains to create a continuous growth cycle. If you want to achieve financial freedom, it's worth learning from these principles and starting to think about how you can use debt intelligently to grow your own wealth. Now, I want to know, which of these strategies do you think you can apply to your financial life? Leave your comment below and share your thoughts. If you liked this video, don't forget to hit the like button, subscribe to the channel, and for more tips on how to build your wealth, watch the next video that's appearing on your screen now. See you next time. I'll see you there.